Hi there, it's Friday the 22nd of November 2019. I'm Steve Towers. Welcome to ITB. Let's get started. In regard to the unified approach under Pillar 1, there are two developments to report. The first is that the OECD has published on its website all of the written comments it has received from organisations and individuals on its 9th of October consultation document. There's a large number of comments and a very large number of pages. And the second is that yesterday and today, the public consultation meeting has been held in Paris. You can watch a video of the meeting on the OECD's website. For the link to the relevant page on the OECD website for both of these items, please go to our website or app. Yesterday's discussion at the public consultation meeting raised a number of interesting issues. Firstly, the concepts of routine, residual, and consumer-facing business were criticised as being too vague. Secondly, in order to reduce compliance costs and also to increase the chances of uniform administration, it was suggested that there should be a one-stop shop approach to tax administration. This would mean that one tax authority, probably the tax authority in the parent company's residence jurisdiction, would take responsibility for performing the tax calculations and would share the results with the tax authorities in other jurisdictions. Of course, issues of sovereignty could prevent such an initiative. And thirdly, a global agreement on Pillar 1 should also include a commitment by countries to remove digital services taxes. Meanwhile, in France, the Council of Economic Analysis has released a report which advocates that priority should be given to the Globe proposal under Pillar 2 rather than Pillar 1, based on its estimates of the likely tax revenue impact of the two pillars. For a copy of this report, please go to our website or app. And the proposed DST is moving forward in the Czech Republic. The final draft of the bill for the 7% DST has been approved by the government and will be submitted to the Parliament. The final bill is similar to the original proposal, but some changes have been made. Firstly, the threshold for group revenue from the Czech Republic has been increased to 100 million Czech koruna, which is about 4.3 million US dollars. Secondly, companies whose share of revenue from taxable services in the EU does not exceed 10% of their total revenue in the EU will be excluded. And thirdly, the DST will cease to apply after 2024. For a copy of the government's statement on the final bill, please go to our website or app. In Australia, the tax authorities have issued for public comment draft guidance in regard to the Economic Infrastructure Staples tax concession. Public comments are requested by the 17th of January. For a copy of the draft guidance, please go to our website or app. Also in Australia, the tax authorities have issued for public comment draft guidance in regard to the Australian income tax treatment of the US GILTI regime. In particular, the draft guidance concludes that the US GILTI regime does not correspond to Australia's CFC regime. This conclusion is relevant to the application of Australia's hybrid mismatch rules. Public comments are requested by the 17th of January 2020. For a copy of this draft guidance, please go to our website or app. In China, the tax authorities have issued announcement number 36 of 2019 in regard to the cross-border e-commerce pilot zone. According to the announcement, effective the 1st of January 2020, qualifying e-commerce enterprises will be subject to enterprise income tax on a deemed taxable profit basis in regard to the export of retail goods. The deemed taxable profit will be 4% of revenue. For a copy of this announcement, please go to our website or app. In India, the Mumbai Income Tax Appellate Tribunal has decided an interesting case in regard to the definition of royalties in the India-Singapore Treaty. This is the second attempt by the Indian tax authorities to convince the tribunal to hold that the relevant payments fall within the treaty definition of royalties. The previous attempt earlier this year failed. This current attempt concerns another year of assessment and allowed the tax authorities to elaborate on their arguments. A Singapore company provided bandwidth services to an Indian company in return for service fees. Two important factual points should be noted. Firstly, the Indian company had no physical control of the infrastructure by which the bandwidth services were provided. And secondly, the process used by the Singapore company to provide the services was not secret. It was a standard commercial process which was followed by other companies in the industry. Here is the relevant part of the definition of royalties in Article 12.3 of the India-Singapore Treaty. The term royalties, as used in this article, means payments of any kind received as a consideration for the use of or the right to use A. Any secret formula or process, B. Any industrial, commercial or scientific equipment. The tax authorities' arguments before the tribunal focused on the phrase secret process in paragraph A. The tax authorities accepted that, but for explanation 6 in the Indian domestic law, the payments in this case were not for the use of or the right to use any secret process. But then they pointed to explanation 6. For the removal of doubts, it is hereby clarified that the expression process includes and shall be deemed to have always included transmission by satellite, cable, optic fibre, or by any other similar technology, whether or not such process is secret. Explanation 6 was inserted into the domestic law in 2012, but with retrospective effect from 1976. The India-Singapore Treaty was signed in 1994 and entered into force in May of that year. The definition of royalties has not been amended, and Explanation 6 becomes relevant because of Article 3.2 in the treaty. As regards the application of the agreement by a contracting state, any term not defined therein shall, unless the context otherwise requires, have the meaning which it has under the law of that state concerning the taxes to which the agreement applies. I have two things to point out in regard to this provision. Firstly, Article 3.2 applies to any term not defined in the agreement. I'll come back to the significance of that phrase, any term. Secondly, you'll notice that this version of Article 3.2 does not contain the ambulatory words at any time, at that time, which were introduced into the OECD Model Treaty in 1995. Thus, this version opens up the issue of whether an ambulatory or static interpretation should be used. Based on those facts and those provisions, the tribunal considered whether Explanation 6 could be used to adjust the meaning of secret process in the royalties definition in the treaty to process, whether secret or not. The tribunal held that Explanation 6 could not be used for that purpose. It gave two reasons. The tribunal's first reason relates to the phrase any term, which is used in Article 3.2. It held that the word process in the royalties definition in the treaty is not a term, and therefore Article 3.2 cannot apply to it. The tribunal said this: the expression process is defined in the domestic law, but this definition is in the limited context of explaining the term royalty under the domestic law. It cannot be borrowed in the treaty for understanding connotations of royalty under the treaty. It cannot be, in our humble understanding, open to pick up a part of the definition of royalty under the domestic law and supply the same to an undefined expression in the definition of royalty under the treaty. The expression process is not a treaty term per se, or a reference point used in the treaty. Rather, it is an expression or word used in defining the treaty term royalty. And the tribunal's second reason is that even if the word process is accepted as a treaty term, Article 3.2 of the India-Singapore Treaty should be given a static interpretation. This would mean that only a domestic law meaning, which existed when the treaty was signed and entered into force in 1994, could be used under Article 3.2. And as Explanation 6 was inserted into the domestic law in 2012, although with retrospective effect from 1976, it did not exist in 1994. The tribunal reached this view with reliance on Article 26 of the Vienna Convention on the Law of Treaties, which, although it hasn't been signed by India, is accepted as being declaratory of customary international law. The tribunal also distinguished an earlier decision of the Bombay High Court, which was on a differently worded Article 3.2 in another treaty. For a copy of this case, please go to our website or app. In Singapore, the tax authorities have issued guidance on the GST treatment of digital payment tokens. For a copy of the guidance, please go to our website or app. The European Court of Justice has decided a VAT case in regard to the exemption for independent groups of persons. The exemption is available under Article 132(1)(f) of the EU VAT Directive, which is set out here. However, Article 131 says this: the exemptions provided for in Article 132 and other specified articles shall apply without prejudice to other community provisions and in accordance with conditions which the member states shall lay down for the purposes of ensuring the correct and straightforward application of those exemptions and of preventing any possible evasion, avoidance, or abuse. This case concerns the conditions which Belgium laid down for the exemption in Article 132(1)(f). The taxpayer is an association which specialises in hospital IT. Its members are public centres for social welfare. The objective of the association is to provide, analyse, organise and manage computer systems to support the management of the hospitals of its members and associated activities carried on by its members. However, in addition to providing the hospital IT services to its members, the association also supplies services to non-members. Under the Belgian national law, the Article 132(1)(f) exemption has a condition that services must be provided exclusively to members. The issue in the case was whether such an exclusivity condition was permitted under Article 131. The court said no. It held that such an exclusivity condition establishes an irrebuttable presumption that the provision of services to non-members constitutes evasion, avoidance, or abuse. For a condition to be valid under Article 131, the link between the condition and the prevention of any possible evasion, avoidance, or abuse needs to be clear. For a copy of this case, please go to our website or app. Also, in regard to the ECJ, Advocate General Kokot has issued an interesting opinion in regard to the fixed establishment rule for VAT purposes. The case is Dongyang Electronics. The taxpayer is a Polish subsidiary of a Korean parent company. The issue in the case is whether the Polish subsidiary constitutes a fixed establishment in Poland of the Korean parent company. The concept of fixed establishment is relevant to the place of supply rules in Article 44 of the VAT Directive, which is set out here. The term fixed establishment is defined in EU regulations in this way. For the application of Article 44 of the VAT Directive, a fixed establishment shall be any establishment characterised by a sufficient degree of permanence and a suitable structure in terms of human and technical resources to enable it to receive and use the services provided to it for its own needs. AG Kokot's opinion provides two answers. The first is this. In principle, a subsidiary of a company from a third country is not a fixed establishment of the latter within the meaning of Article 44 of the VAT Directive. But the second is this. A different conclusion is conceivable only if the contractual structure chosen by the customer were to infringe the prohibition of abusive practices. This assessment falls within the remit of the referring court. For a copy of the opinion, please go to our website or app. The European Commission has announced 2 EU state aid decisions in regard to corporate income tax exemptions provided to ports. Firstly, in regard to Spain, which has agreed to amend its corporate income tax legislation to bring it in line with state aid rules, the Commission has announced the closure of its existing procedure concerning Spain. But secondly, in regard to Italy, which has not agreed to similarly amend its corporate income tax legislation, the Commission has opened an in-depth state aid investigation. For a copy of the Commission's press release on this matter, please go to our website or app. Also in the EU, the difficult issue of public CBC reporting is back. The Finnish presidency has put the topic on the agenda of the 28th of November meeting of the Competitiveness Council, where only a majority support is required. If it were instead treated as a taxation topic, it would require unanimous support. And finally, in the EU, the European Commission's VAT expert group will hold its next meeting next Wednesday. 2 documents have been released ahead of the meeting. The first is an updated version of the draft explanatory notes on the 2020 quick fixes. And the second is a document on upgrading the EU VAT system. For a copy of both documents, please go to our website or app. In the Netherlands, the Hague Court of Appeal has decided a case on the deductibility of interest on intragroup debt. The case concerns a complex intragroup financing plan. But in simple terms, and focusing on the taxpayer, a Dutch company, Dutchco 1, borrowed money at interest from a related US company, and use the funds to subscribe for share capital in a related Dutch company, Dutchco2. The Dutch tax authorities claimed that the interest payments were non-deductible under various provisions of Dutch tax law and under the general anti-avoidance rule. However, the court held in favour of the taxpayer on all of these points. For a copy of this case, please go to our website or app. In Switzerland, the Federal Council has approved ordinances which will implement tax reform measures concerning the patent box regime, the notional interest deduction, and the credit for foreign withholding tax. For a copy of the government's statement on this matter, which includes a copy of the ordinances, please go to our website or app. In the UK, the corporation tax rate is an issue in the general election, which will be held on the 12th of December. The current rate is 19%. It's scheduled to fall to 17% on the 1st of April 2020. However, this week, the Conservatives announced that their policy is to postpone that rate cut. In contrast, the Labour Party would gradually return the rate to 26%. Also in the UK, the First-Tier Tribunal has decided a case in regard to whether an input tax credit can be obtained for VAT incurred on tax advisory fees. The taxpayer company is VAT registered and makes taxable supplies. It engaged a tax advisor for advice on how to provide its executive directors with a tax-efficient bonus. In accordance with the advice, the taxpayer company issued a special class of shares to the directors. The tax advisor charged a fee plus VAT for the advice. The issue in the case was whether the taxpayer company could obtain an input tax credit for the VAT it incurred on the tax advisory fee. The tribunal held that the taxpayer company is entitled to an input tax credit for the VAT. It gave two reasons. The first reason was that the tax advisory services did not have a direct and immediate connection with the issue of share capital. The tribunal said this: "I am required to consider the true purpose of the arrangements and to look through any initial transaction to ascertain objectively the overall purpose of the arrangements, considering all the circumstances. In my view, the ultimate purpose of these arrangements was to incentivize the company's employees in a tax-efficient manner from the perspective of both the company and the employee. And the second reason is that the tax advisory services were used for the purpose of the taxpayer company's business." The tribunal said this: "In my opinion, the incentivization of employees, even though in this case they were directors and shareholders of the company, has a direct and immediate link to the purposes of the business." For a copy of this case, please go to our website or app. Kenya has enacted the Finance Act 2019, which includes most of the items which were announced in the country's 2019 budget. But there are a couple of important differences between the budget and the Act. Let me take you through them. Firstly, in regard to VAT, the Finance Act includes an important and unusual item which was not mentioned in the budget. The existing reverse charge mechanism, which currently applies only to VAT-registered recipients of imported services, will be extended to unregistered recipients of imported services. And secondly, the Finance Act elaborates on the general announcement in the budget that the government would announce tax measures to deal with income from digitalisation. The Finance Act contains two provisions in regard to digital marketplaces. an income tax provision which says that income accruing through a digital marketplace is taxable in Kenya, and a VAT provision which says that VAT will be applicable to supplies made through a digital marketplace. In regard to both provisions, regulations will be issued by the government. For a copy of the Act, please go to our website or app. In Nigeria, the Tax Appeal Tribunal has decided a case in regard to the VAT treatment of services provided to a non-resident company. The taxpayer is a Nigerian resident company. It entered into an agreement to perform services for its South African resident parent company. The parent company has no physical presence in Nigeria. The agreement required the Nigerian company to act as the parent company's agent in marketing and distributing in Nigeria the parent company's investment funds. That is, investment funds for which the parent company was the investment manager. Under Nigeria's VAT law, exported services are exempt from VAT. The term exported service is defined to mean service performed by a Nigerian resident or a Nigerian company to a person outside Nigeria. The tribunal held that the parent company was effectively carrying on business in Nigeria by virtue of the marketing and distribution services performed by its agent, the Nigerian company. And therefore, the parent company was not a person outside Nigeria, and accordingly, the services were not exported services. As a consequence, the services were subject to VAT. It's interesting to note that the Finance Bill, which is currently before Parliament, will replace the definition of exported service with this new definition. Means a service rendered within or outside Nigeria by a person resident in Nigeria to a person resident outside Nigeria. Provided, however, that a service provided to the fixed base or permanent establishment of a non-resident person shall not qualify as exported services. For a copy of this case, please go to our website or app. In Zimbabwe, the government has presented its 2020 budget. Only a few items caught my eye. There will be a small reduction in the rate of corporate income tax from 25% to 24%. And there's also a small reduction in the standard rate of VAT from 15% to 14.5%. And also in regard to VAT, inbound digital, radio and television services will be subject to VAT. And VAT on imported services will qualify for input tax credit. In Kazakhstan, the government has delayed the imposition of VAT on inbound B2C digital services. The new rules will now be effective on the 1st of January 2021. In Brazil, the government has announced in a newspaper interview a proposal to introduce into the National Congress major tax reform bills in 4 phases over the next 8 months. The first phase will be this month. It will consist of a bill to replace 2 social contribution taxes with a new contribution on goods and services, which will be called CBS, using its Portuguese acronym. The CBS will be imposed at a single rate between 11% and 12% and will allow input credits for CBS paid on inputs. The CBS sounds to me like a VAT. The second phase will be at the start of 2020. It will consist of a bill which will redesign the excise tax on manufactured products. The third phase will be at the end of March 2020. It will consist of a bill which will amend the individual income tax and the corporate taxes on net profits. In regard to corporate taxes on net profits, the aggregate tax rate is currently 34%. The government is considering reducing that aggregate rate gradually over 5 to 7 years to reach an aggregate rate of 20%. The bill will also introduce a tax on dividends, which are currently exempt. And the fourth phase will be in mid-2020. It will consist of a bill which will reduce a company's payroll taxes. And in addition to this four-phase plan, you'll remember that there are already two alternative bills currently in the National Congress which aim to simplify Brazil's myriad of indirect taxes. In Ecuador, the major tax reform bill, which was introduced by the government into Parliament a few weeks ago, was rejected by the Parliament this week. It's been reported that the government is working on a revised bill. In the US, the IRS and Treasury have issued final regulations in regard to the stock ownership rules in Section 954 and the derivation of rents in the active conduct of a trade or business. The final regulations are the same as the proposed regulations which were issued earlier this year. For a copy of the final regs, please go to our website or app. And now for this week's treaty developments. We've had 4 treaties signed, 1 protocol signed, and 2 treaties enter into force. I have 3 articles for you this week. The first article is called How to Treat the Ride-Hailing Company Uber for VAT Purposes. It's written by Lily Zechner and it's published in the International VAT Monitor. In this article, the author analyses how Uber should be treated under the EU VAT rules. She concludes in this way. Based on the analysis performed in this paper, the author concludes that Uber provides passenger transport services as an undisclosed agent within the meaning of Article 28 of the EU VAT Directive. Under Article 28, Uber is presumed to have supplied the passenger transport itself. The place of Uber's supply is where the passenger transport takes place. This result is appropriate because in this way the supply is taxable where the consumption takes place. The question of who must account for the VAT depends on whether the passengers are taxable persons or final consumers. The author concludes that where Uber provides its services to final consumers, it is liable for the output VAT. The second article is called Beat, an overview of the statute and proposed regulations. It's written by Danielle Rolfs, Guy Bracuti, Jesse Eggett, Joshua Kaplan, and Sivan Kozar, and it's published in the Tax Management International Journal. This article provides a good overview of the US Base Erosion and Anti-Abuse Tax, the BEAT, which was enacted as part of the 2017 US tax reform legislation. The BEAT imposes an additional tax on certain large corporate taxpayers which make base erosion payments, which include deductible payments and certain other categories of payments, to certain related foreign persons. The article focuses on Section 59A of the Internal Revenue Code and the proposed regulations which were issued in December 2018 and which have not yet been finalised. However, it doesn't cover the interaction of BEAT with the non-discrimination article in the US double tax treaties, which is a bit disappointing. And the third article is called Analysing the Italian Digital Services Tax Through European Glasses. It's written by Raul Angelo Papotti and Martha Casiero, and it's published in Tax Notes Today International. This article provides a good overview of the Italian DST, which has been enacted into legislation but has not yet commenced operation. The article compares the Italian DST with the EU DST directive, which was proposed by the European Commission. Well, that's the way it is this Friday, the 22nd of November 2019. I'm Steve Towers. Have a great weekend.